Structure IUL correctly and fund it properly. That's the way it was intended by E.F. Hutton, the brainchild behind the emergence of universal life and now indexed universal life. So this is the first thing. Stop funding a policy just based upon target. That's not going to cut it. And the original death benefit was $1 million. What's the net death benefit at risk? 0. You're self-insured now. Your cash value has grown to equal and exceed the death benefit. That is a properly structured, max-funded, indexed universal life. You fill it up as fast as the IRS allows under TAMRA, and it will provide tax-free income. So in this episode, I'm going to talk about what that means, how to structure it correctly to accommodate the goals to be able to accumulate money tax-free, allow you to access that money tax-free, and when you ultimately pass away, it blossoms and transfers income tax-free. But to create a perfect dream solution for retirement or any other financial goal in order to do that. But you have to fund it properly. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping people optimize their assets, minimize taxes, empower what I call their authentic wealth. If you've watched very many of my educational episodes, my favorite financial instrument, without question, is a properly structured, max-funded, indexed universal life. So what do I mean by that? Well, the biggest problem I see is a lot of insurance agents or financial advisors in America. They set up an indexed universal life policy and they fund it based upon target premium. Now, you may not know what that means, but target premium is not only the premium that generally the insurance company recommends, that if you pay the target premium every year into that policy, based upon certain assumptions in the policy or rates of return that they feel like are guaranteed or whatever, or that they can assure that the policy will stay in force until a given age, let's say age 65. That's generally what it means, but it's also the portion of the premium that the insurance company bases commission compensation on. So unfortunately, there's a lot of agents who only sell policies based upon target premium because maybe they're looking out to try to maximize their earnings on a policy, and they're not really trying to achieve a financial goal for you at the optimum rate of return they could. What does this mean? Okay, I'm going to just cut to the chase. If you're setting up an IUL policy for living benefits as an alternative to IRAs or 401ks, the difference between setting it up on target would be that if over a 20, 30-year period, you were putting in $500 a month, $1,000 a month or whatever, or even repositioning lump sums, if you don't rebalance and diversify, if all you do is pay target premium, you might be lucky to earn an average gross rate of return in the 7 to 8% range, but your net internal rate of return, I can't believe how many insurance agents, mostly whole life agents, don't even understand that term. The net internal rate of return, that means after all costs, what is the rate of return that you would need to accumulate that much money by a given date or age, okay, age 65. So for example, whole life insurance, many agents will say, oh, this whole life policy will average 8%. Well, it takes until age 95 before the net rate of return, internal rate of return, is 5.9, meaning the actual costs clear until age 95 drained out more than 2%. If you earn 8, you're netting 6. Does that make sense? I would rather earn 10 or 11 and net 9, okay, or net 10. You can do that with indexed universal life, and a lot of whole life agents don't even understand how to do this. They don't even understand internal rate of return. So if all you're going to do is pay target premium, you're going to be lucky to earn maybe 7 or 8%, but you might only net 2 or 3% because the cost of insurance was draining out a big chunk of your overall rate of return. Most of my clients came to me wanting the best internal rate of return to use it for living benefits. so that by rebalancing and diversifying, we can move the gross rate of return up to 11.17 has been my average, to be honest with you, okay? But net, over 10%, 10.07, within about 1% of the gross rate of return, retroactive back to day one, meaning if I'm going to end up with $1 million, let's say, at age 65, on what I've paid into that IUL policy, I would have had to have been earning 10.07% interest compounded tax-free to end up with $1 million. The cost of insurance came along for the ride. It was being paid for because I actually earned 11 and netted 10, because that 1 percentage point paid for all of the costs and fees in the policy. That is money that would otherwise go out the window in unnecessary taxes. If I followed the herd and put my money in traditional IRAs or 401ks, I'd have to be earning 15 or 16% after taxes and fees to net 10. In a property structure max funded IUL, I only have to earn 11 to net 10. Does that make sense? If it's not making sense, you need to learn this, because this is critical. So this is the first thing. Stop funding a policy just based upon target. That's not going to cut it. So what am I talking about? When E.F. Hutton, who is credited with being the brainchild behind the emergence of universal life in 1980, and then indexed universal life came out in 1997 when interest rates started to come down, it was based upon 3 sections of the Internal Revenue Code that have been around for 108 plus years now. Section 72E, which says money that accumulates inside of an insurance policy, a permanent life insurance policy, is tax-free, okay? And Section 7702 says that you can access money while you're alive, totally income tax-free for all kinds of living benefits or whatever. And then at the end of the day, when you finally pass away, sooner or later, anything left in the policy will blossom and transfer income tax-free under Section 101A of the Code. But the objective is not to get the most insurance for the least amount of premium. You can do that with term life insurance if you want. The objective is to take the least amount of insurance that you can get away with under the IRS rules and put in the most premium that the IRS allows as fast as they allow. So you're actually doing a backdoor approach is what I call it. People would come to me and tell me how much they could afford to set aside. $500 a month, $10,000 a year, $20,000 a year, $500,000 a year, whatever, okay? We're going to use an example of $500,000 here in just a moment. Then you're taking the least amount of insurance the IRS will let you get away with. Well, how is that dictated? Well, in 1982 and then 1984, the IRS convinced Congress to come up with some tax laws. These are tax citations. And these are acronyms, the Tax Equity Fiscal Responsibility Act of 1982 and the Deficit Reduction Act of 1984. What do they mean? Well, TERA and DEFRA provides this corridor based upon your age, your gender, and your health that gives parity. That means equality. What does that mean? If your objective is living benefits, you want the best rate of return on your money, TERA and DEFRA allows you, based upon your age, your gender, and your health, to squeeze down the death benefit to get away with less insurance the older you are and more unhealthy you are, so that you can get the same rate of return. You can earn 11 and net 10, just like a 22-year-old athletic marathon running female, even though you're 78 years old. Like one of the friends of our family back in the 1980s, he came to us at age 78. He had 3 blocked arteries, adult onset diabetes, a prostate cancer episode, 6 sisters predeceased him, and 3 brothers. He was rated table D. That means he has to pay twice as much for the cost of insurance as a normal 78-year-old who's healthy. We were able to squeeze down the death benefit so that he could earn 11 and net 10 just like a 20-year-old could. And he got away with less insurance. He put in $500,000 and started taking out $50,000 a year tax-free instantly. Yep, because the cost of the insurance is the same. No matter how old you are, unhealthy you are, and it gets cheaper as you get older. You ever seen an insurance policy get cheaper as you get older? You haven't seen one done right then, okay? TERA and DEFRA then has to do with the minimum amount of insurance that has to come along for the ride based upon your age, your gender, and your health. The older you are and the more unhealthy you are, the less insurance you can get away with so that you can get the same rate of return. Now, in 1988, June 21st to be exact, the Technical and Miscellaneous Revenue Act was passed. That tax citation said, golly, these are so good. The banks and credit unions lobbied Congress and they said, you got to slow the flow. We can't compete. So that is TAMRA, and that has to do with if you want to have tax-free income out of this, you have to comply with TAMRA. So what does this mean? I use the metaphor of a bucket, have for years. Let's say this bucket is an IUL policy, and to structure it correctly and fund it properly, I want to design a bucket big enough to accommodate the amount of money I want to be grandfathered to put in it, to pay into it. So let's say that I'm a 60-year-old male, and I want to reposition $500,000 to increase the liquidity, safety, rate of return, and the tax benefits of that money. It could be $200,000 coming out of IRAs and 401ks that are in a volatile market and are going to be taxed, and you're not in a lower tax bracket. So you do a strategic rollout of that $200,000, and that's what you net after tax. It could be another $200,000 from, let's say, a rental property, a rental home that you're sick and tired of being the landlord, fixing the toilets, taking out the trash, and evicting tenants. You just want to get rid of it, and you want to know what to do with that $200,000. I've done that many, many thousands of times. And let's say you have another $100,000 of underperforming assets. It's just money in a bank or credit union. You're going upstream at the rate of 1 or 2 miles an hour, or 1 or 2% interest, and the current of inflation's coming down at 5, 6, 7, 8, 9, 10. You're going backwards, so you want to increase the rate of return and also hedge against inflation. So there's $500,000. Now, if I put in $500,000 in one fell swoop, I violate TAMRA. It'll still grow tax-free, and it will blossom and transfer income tax-free. But if I want tax-free income, I need to comply with TAMRA. So TERA and DEFRA says this. If I'm a male age 60, there's a whole bunch of life insurance I could buy for $500,000. That's not the objective. I want the least amount of insurance. So I go into there, and if I'm a healthy 60-year-old, I can get by with about double what that is, about $1 million. If I'm an unhealthy 60-year-old but can still qualify, I might get by with $700,000 or $800,000 of insurance, because it's not the insurance that I'm going after. It's this growing tax-free. Let's say I'm totally uninsurable. I can use my spouse, my kids. I can use a surrogate, because it's the owner of this that gets all the tax-free accumulation and tax-free income, okay? But let's say you're 60, you're in decent health, so I can get $1 million of insurance on that $500,000. And then TAMRA says, well, you can't put in $500,000 all at once, or it'll be taxable when you go to turn on income. I have to spread it out over, let's say, about 5 years. So let's just divide it by 5. We can put in $100,000 the first year, $100,000 the first day of the second year. So that's 1 year and 1 day. And I do that third year, fourth year. And so in 4 years and 1 day, I now have my $500,000 in there. And so in 4 years and 1 day, it now has $500,000 in there. What's the net amount at risk? Well, if $500,000 of that million is my own money now, then if I died and they pay out $1 million, well, $500,000 of that is just a return of the $500,000 I put in there. But the insurance company's only charging me, this is the spigot on the bucket, the cost of the insurance. The insurance company's only charging me for the net amount at risk, the difference between the $1 million and the $500,000, which is now my money. Well, on many of mine, I've averaged 9 to 10%, let's say 9.6%. 9.6 divided into the rule of 72, my money will double in 7.5 years. Many times, my clients, the $500,000, once it was in there, doubled by the 11th year of the policy to $1 million. Now you've got $1 million of cash, and the original death benefit was $1 million. What's the net death benefit at risk? 0. You're self-insured now. Your cash value has grown to equal and exceed the death benefit. This is like buy term, invest the difference on steroids. This is why it's so critical to understand how to structure it properly and fund it, because you're self-insured in 11 or 12 years, maybe 15 years. You don't have to wait 30 or 40 years to have the cash equal the death benefit. Now, TERA and DEFRA says the death benefit, if I happen to die, has to pay out 5% more. If I died in the 11th year, the death benefit would pay out $1,050,000, but the insurance company's only charging me for $50,000 of death benefit. The interest on $1 million of cash is way greater than the cost of insurance for $50,000 of net death benefit. Let's say the million doubles in another 7.5 years to $2 million. If I die, it leaves behind $2.1 million. But I have $2 million of cash in there that can generate $200,000 a year of tax-free income because it's structured correctly. So I'm getting a net internal rate of return of 10%. You just do the math, okay? So that's the beauty of structuring it correctly and funding it properly. The internal rate of return gets within 1% of the gross rate of return, retroactive back to day one when I first opened it up. But when I first opened it up and it was only 20% funded, this isn't a short-term investment. How can this perform well when it's only 20% funded? So I like to use the metaphor of a 5-story building, okay? If I built a 5-story building and the IRS said, hey, listen, you've got 5 stories here, but if you just sort of rent out 1 floor a year, after 4 years and 1 day, the building can be fully occupied and then it's all tax-free, do the math, that's worth it. And so if I fill up the first floor in the building the first year, and the first day of the second year, I can rent out the second floor, and then the third floor, and then the fourth floor. And then in 4 years and 1 day, my building is 100% full. Now it turns into a cash cow, and it's totally tax-free. That is a properly structured, max-funded, indexed universal life. You fill it up as fast as the IRS allows under TAMRA, and it will provide tax-free income that will then give you like a 10% payout into perpetuity, so that every million you accumulate can generate $100,000 a year of tax-free income without depleting principal if you live to be 120. We have many, many clients who have done that. So folks, if this is resonating with you and you want to learn more about this, I would strongly recommend you claim a free copy of my most recent best-selling book. It's flying off of our warehouse shelves. We're in the 9th edition of this. We send out over 500 of these a week. I don't want you to miss out. It's 300 pages, jam-packed with charts, graphs, and explanations, and 62 actual client stories. You have the left brain side, and then you have the right brain side. It's actually 2 books in 1. So to claim your free copy of this book, you simply click on the link below or go to laserfund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. But when you're in there claiming your free copy, if you like to listen and learn or watch and learn, check out those options. We teach educational webinars all the time. They're free. You can register for one of those. But if you want to talk to an IUL certified professional, I oversee them. There's just a handful in the country. I can point you to them, and you can schedule an appointment when you go in to claim your free copy to have a free consultation and analysis with no cost or obligation on your part to see how these strategies may apply to you if it's structured correctly and funded properly. That would be well worth your time, and I would strongly recommend you only talk to a certified IUL professional so that you know that it's going to be structured correctly and funded properly, or it's going to be extremely costly, and you're going to end up with one that where you could have earned 11 and netted 10, you might only earn 7 and net 3. Don't let that happen to you.